It's no secret gold and silver has been skyrocketing this year. It's the big winner. But is it done? Is it at a point where you should be getting gold and silver? Is that the new thing we should be getting into? Is there ways to actually invest and make this work? That's what we're going to talk about today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor, where you're here because you want to become work optional, where you want to have enough passive income to work because you want to, not because you have to. And of course, if you haven't done so now, we always ask if you've forgotten to do it, subscribe to our YouTube channel. We're almost at 5,000 subscribers. We'd love to have you be part of that. And of course, if you already done that, feel free to follow us on social media at Money Ripples on all platforms. All right, guys, so I'm bringing back a return guest. If you haven't followed us that long, we actually had on before David McAlvany. Now, David McAlvany is with the McAlvany Group. The reason I bring him on is because these guys have got 50 years of experience dealing with gold and silver. Pretty much post-Nixon, taking us off the gold standard, that's when these guys really got into it. So I want to bring somebody on because I want to know for myself, is gold and silver, is it too high? Is it too hot? Because if everybody's talking about buying it, does that mean it's the wrong time? Or is there something more to the story that we don't realize? And so that's where we're bringing on David today. So David, welcome to our show.
Great to be back, Chris. Thanks for having me.
Absolutely. Yeah, you're back for a repeat. So for those that don't know about you guys, I gave a little bit of background about your group because obviously you guys got a breadth of experience here. Tell us a little bit more about you.
Well, since 1972, the family has been, and I'm a part of it, has been managing precious metals exposures for individual investors. And so gold, silver, platinum, palladium, we brokered metals, billions and billions of dollars worth of metals through the years. Probably our claim to fame is originally in the 70s, we helped get gold legalized. So, you wouldn't have the privilege of investing in it if it wasn't for Senator Jesse Helms shifting the legislation, and we helped with that lobbying effort. So that was in the 70s. January 1st, 1975, all that changed.
The fact that anybody can own gold and anything else right now is because some of the efforts you guys did.
Yeah, so we've been in the industry since the beginning, and we also have an asset management company. We started managing equity portfolios in 2008. A great time to get started. And again, a differentiator there is we know how to manage risk pretty well, and made money in 2008 and 9 when a tough environment during the global financial crisis. And we tend to focus on hard assets, so natural resources, companies that specifically derive their value from precious metals, natural resources, infrastructure, and real estate, but typically in the form of REITs. So that's what we focus on. The two businesses, one is sort of the offense, one is the defense, and they tend to marry up pretty well.
I was going to ask this question, but I think I'm just going to roll into it because it's kind of a good segue what you just said here. I mean, I know a lot of people will say, "Oh, I'm going to, go into gold mining companies, for example, right, versus buying the actual gold asset." What are your thoughts on that?
I think it's a different mandate altogether. If you want growth and specifically, leverage on the operations themselves, it's a great way to go. It's one of the areas that we do focus on. And, up to 25% of our current allocations are in the precious metals miners. It is a growth play. And I'd say you have to follow kind of the 90-10 rule with precious metals miners. 90% of the time, you don't want to touch them with a 10-foot pole. And 10% of the time, they perform really well. Those indices are up 125% year to date, while silver's up over 70 and gold's coming up at 60% year to date. So they tend to give you that extra boost in terms of growth. But I'll tell you, it's a space that is fraught. If you're in the wrong geography, if you're with the wrong management, if they're not managing their balance sheet very well, or if you've got a CEO who's a wild-eyed commodity speculator and isn't a very good business manager, there's a whole host of things that can go wrong. So we have a team of analysts that go through with a fine-tooth comb and find the very best assets, the very best management in just the right geography. So I'd say be careful. The mandate is growth. That is going to be different than gold, where it's actually an insurance mandate. For us, it's a way that you insure your wealth, and it dampens volatility for an equity portfolio. Physical gold and silver do on occasion have their day in the sun. We're in that right now. We've got and silver on the move, and it's generally an indication of stress in the system, of degradation of trust, and that could be in government, policymakers, between governments, geopolitically. Whenever there's stress or uncertainty, gold and silver do very well. What's unique in 2025 is that it's doing well at the same time the equity markets are doing well. Typically, they're inverse to each other.
Right.
This time they're moving up together. I think one of the next major moves higher for the metals is with a decline in equities, pressure in the financial markets, and then you have a real migration of assets that direction. We can talk about that because I do think that gold and silver are expensive. I do think that they are overbought, but I also think that they are very under-owned. So we could talk about that.
Yeah, let's talk about that because that was my concern is that when I start hearing Main Street media say gold and silver, this is the place, this is the champion, right? That's usually a time when you start seeing dumb money go in, and then that's usually after that you have a correction that follows. Now, for me, I know for myself, I've been buying gold and silver as like Federal Reserve insurance. As if they're going to print more money, I had that insurance in play, and I'm grateful I bought gold and silver way cheaper than it is today. But that being said, I know that for some people, that could be a rough ride. So what are you seeing happening right now with that?
Yeah, when I say it's overbought, that's surely a technical comment. And you look at the charts, and we're at a point where we could and should see a correction. The challenge with that is when gold and silver get on a move, they can stay overbought for 6, 12, 18 months. And so we are overbought. We should have a correction, but we may not get one. And a part of that is because it's so underowned. There was a recent survey by Bank of America, and their asset management team had on average about a 2.4% allocation to gold. When they did a survey of their private clients, they had less than 0.4% allocated to gold. And if you look at the ETFs, both with the miners and with the metal itself, GLD and SLV, you've actually had a contraction in shares. That is a shrinkage of available product in those forms because demand has been tepid. Certainly the last 6 to 8 weeks, that's beginning to flip. But year to date, those are vehicles that show actually people exiting, not entering in mass. So what you've had, Chris, is the central banks set the tone. Central banks have been driving the price, particularly of gold, and the investor has not. The average investor has not. Just now recently, it's catching their attention. And with eye-popping returns, it's no wonder that they're beginning to pay attention. So one of the things I would keep in mind is this dramatic shift, and I would say we're at the very front edge of it. Wall Street's perception of gold is beginning to change. I'll give you a couple examples. You've got Michael Hartnett, who is a very good macro analyst, recently coming out with a $6,000 gold price projection by the first quarter of next year. Michael Hartnett is at B of A, and then you've got the chief investment officer, Mike Wilson, at Morgan Stanley, and he this is really what's radical. He's suggesting the old 60-40 portfolio mix between stocks and bonds should, in the modern era, be 60-20-20. 60% stocks, 20% fixed income, 20% gold. Now, obviously, the B of A survey would suggest you're nowhere close to 20%. Even your professional investors have limited or capped their exposure to 2.4%. Their private clients, less than 1%, not a 20% number. Then you've got Jeffrey Gundlach, who manages fixed income for DoubleLine Capital. He's a person who makes money in fixed income. He trades bonds, and his recommendation is 25% stocks, 25% bonds, 25% cash, 25% gold. That is radical. And I'd say not radical because those numbers are so high, but because you're seeing mainstream investors look at the financial landscape through a different lens. And I think the general public does not appreciate the lens through which these professionals are seeing the world that we live in, the changes that are taking place, the implications for that. You don't change a 60-40 mix, which has been popular for the last 40 years.
Right.
You don't change that to a 60-20 unless you think that there is a regime change, a fundamental shift in the way we're operating economically, interacting with our trade partners, et cetera, where all of a sudden a healthy gold exposure, double digits, is implicit and needs to be there. In fact, Mike Wilson describes that 20% allocation to gold as the anti-fragile element in a portfolio. Why would you need something that's anti-fragile? Well, we live in a very different world, a world that to some people is very concerning. And I think the equity investor is the last to realize this regime shift. And so I frankly think that this under-owned aspect is the most important with gold. We don't have much of an imagination seeing gold trade at $6,000 or $8,000 or $10,000 an ounce. But when there is particularly a monetary regime change, potentially pressure on the US dollar, more than we've seen in recent decades, you can reprice all assets towards infinity. If the slow march of the dollar is in the direction of zero, then real assets can be priced to infinity. That's the story of hyperinflation. I don't think that's the case in the US or with the US dollar. But to a degree, if inflation is going to linger, you're going to see a repricing of the asset class.
Yeah. Well, in my opinion, I feel like it's been repressed for so long because I remember in 2011 selling off silver ounce coins for $47 an ounce, right? And now we finally just barely passed that in October, right? I mean, that's a pretty shocking thing to me. If you look at almost any other asset class, you'd say, boy, this one sucks, but obviously it corrected. It was we're overbought, it corrected, and now it's coming back up. So what's your opinion with something like silver? Because I know many people talk about gold and silver kind of gets ignored a little bit, but I know silver it's a lot more scarce. I know it has a lot more utility. And I know you have other metals you talk about too. What's your opinion on that?
Silver's breaking above $50 an ounce is the equivalent of gold breaking above 2,000 an ounce. We're in a new territory. And to see the price move on a vertical basis, I think you can expect it. It's a very small market relative to gold, and so it doesn't take a lot of investor capital to see the price move rapidly to the upside. So one of the things that we look at is not price, but its relationship to gold, and it's at about 80 to 1, the ratio between the two. 1 ounce of gold equals 80 ounces of silver. And at this point in the precious metal cycle, we think that should be closer to its long-term average at around 65. So even that, taking less ounces to buy or have the equivalent value of gold, implies that we should be at $60 an ounce right now.
If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
So from 53 to 60, we can close that gap by the end of the month. I mean, it could be that fast. The ratio is key to watch. If you want to know when silver is sort of overdone, then you'd be in the 50s, you'd be in the 40s relative to gold. So keeping in mind the ratio, it's a great way of saying, well, it's high. What's too high? Too high would be that ratio above a 40 to 1 ratio. The best we've seen in the last several decades was 2011 when it traded at 31 to 1.
Right. That's low.
That's very low, but that implies silver massive outperformance relative to gold. Now, since then, we've had massive underperformance relative to gold, and I think we're just now beginning to see silver catch its stride.
Yeah, no, even in recent history, it was kind of more closer to 100 to 1, which, like I said, I know once you taught that 80 to 1 in the last episode, that's kind of stuck with me. But it's interesting to hear long-term 65 to 1 then, huh?
That's the average. And if you look at a long-term chart of the gold-silver ratio, it will routinely dip to the 40s and 50s, occasionally dip to the 30s. Back in the Hunt Brother days, 1980, it actually got to 15 to 1. Don't look for a repeat of that, but 30 to 1 would be the outlier. And that 40 to 60 range, I think, is a normal trading range. If you're above it, silver is a great value.
Yeah.
And so I think someone allocating to the precious metals, what we like to do, what sets us apart in the industry is trading ratios, trading premiums so that you're compounding your ounces. If I'm
Mhm.
positioning in silver today, it's basically on an agnostic view of the metals and knowing that I'll gladly exchange those silver ounces for gold and end up with twice the number of gold ounces. The net math is buying silver today is like buying $2,000 gold, if that
Mm.
makes sense. So if you
Yeah.
want to position the metals, you feel like the metals have run away from you, then employ a strategy. That's where you would engage with us to help you maximize value, the allocation to the space.
Figure out how much to buy of which
Mhm.
when, right? Because obviously that shifts and
And
changes.
what to do next.
Yeah. Now I know one thing we never hear about is platinum and palladium, and I know you guys deal with that too. What's your thoughts on that right now?
Well, all of the white metals, both silver, platinum, and palladium, have an industrial component. So
Yeah.
one of the things that we always emphasize in a metals portfolio is gold is the metal for all seasons, inflation, deflation, whatever kind of pressures you might see in the financial markets, in the global economy, gold is the king. Your white metals, because of their industrial components, during certain periods can outperform gold, but they can also severely underperform in the context of global deflation or domestic deflation. You see a contraction in demand for the kinds of products that they're inputted into. So we like the metals relative to gold. Platinum and palladium are definitely on the inexpensive side. Platinum has outperformed gold and silver year to date. It's up 80%.
Yes.
So, it is on the move. Part of that is because you've been in 3 years of supply deficit. And so any bit of a shift back, particularly towards internal combustion engines and away from sort of everybody's going to be driving an EV. Just look at California. We're all going the direction of California. Well, if that transition takes longer, that means there's going to be more consumption of ICE vehicles, and the space was left for dead. Buying, stockpiling for internal combustion engines has gone away. Now it's having to come back, and that's what you're seeing right now is sort of a restocking of inventories because ICE is not dead, and EV is not the revolution we thought it was going to be. And maybe 20, 30 years from now, but not on a very short time frame.
Yeah. Fascinating. Now, I know this is the question that a lot of our listeners always ask is, I know internally we talk to our clients about, of course, getting them to be financially independent, but as they start to pass that, building and diversifying out, which obviously metals is a big part of that too. Is there a way to cash flow metals?
Not precisely, but I think using the ratios and the premiums, there is a way to compound the metals.
Mm.
And, in essence, you don't need to cash flow the metals if you're able to compound them. And if you wanted to, as you're compounding and growing the number of ounces, you can always sell a few ounces, the equivalent of an income
Sure.
stream if you wanted. What we see a lot is investors who will own the metals and they know that they've got implicit to that portfolio inflation protection so that in
Yeah.
retirement, whatever they saved is there for them and can buy whatever the adjusted price is for a gallon of gas or a loaf of bread or what have you. And it's interesting to see some of our clients with low cost basis. It's hard to find an asset class that has performed better. I reviewed a portfolio. This was a chaplain, and not somebody who makes a tremendous amount of money, but he had $150,000 that he put into gold and silver in the year 2000,
Oh,
and
wow.
his current value is up over 700%. His annual rate of return on that basis has been almost 27% per year. Can you count on that year in, year out? Absolutely not. But adjusting for inflation and seeing the growth in the assets with that impeccable cost basis,
Mhm.
he'd say, why do I need the cash flow? The
Mhm.
asset does what it does over time. Could you expect that year in, year out? No. Prices go up, prices go down, but he's endured many cycles from 2000 to the present and is certainly in a better position than when he started with that $150,000. So I think the young investor is well served having hard assets as a part of their long-term retirement strategy. I think the older investor who's trying to manage an equity portfolio, bond portfolio, and dampen risk in those assets, again, I think they're well served. What I would say is if we do get a bit of a correction, there's your opportunity. If you're on the fence, then engage with us. We can begin to allocate in the direction of silver because it's less value than gold, and sort of fill out a full portfolio in tranches in the context of a price correction.
Got it. And on that note, I was going to ask you, if somebody wants to follow you or engage with you guys, what's the best way they can do that?
If they go to McAlvany.com, it's a great way to get to know us. We provide a lot of free materials, whether it's hard asset insights, credit bubble bulletin. These are written weekly. We also have two different podcasts. One is Golden Rule Radio, about a 10-minute piece specifically on the metals every Thursday. And then I've done my podcast every week for 18 years, and it covers more of the macro trends. Those would be great ways to get to know us without necessarily, wait a minute, I don't need somebody to call me. Great, kick the tires, get to know us, see what our thinking is on a variety of topics. And if you want to initiate a phone call to us, great. Of course, there's forms you can fill out online, and we'd be happy to get in touch with you to follow up and do a financial review.
Awesome. Yeah. 18 years. Congratulations, by the way. That's impressive.
It wasn't even called podcast at that time. At that
No,
point.
it wasn't.
It didn't exist.
Yeah. It was online radio, right? Yeah. I remember because when somebody mentioned podcast to me in 2008 to start my first podcast before this one, I was like, what's a podcast? I didn't even know what it was. And that was, I guess that would be 17 years ago. So yeah, you were definitely doing it early in the day.
Yep. We love to educate and help folks make informed decisions. It's a guided process. And I think, again, our company is not full of a bunch of high pressure salespeople. We view ourselves as consultants and advisors. We need to listen first, understand the problems that are trying to be solved, and then figure out if or to what degree metals are a part of that picture.
Awesome. All right. Well, yeah, we'll definitely put that in the show notes so everybody can link up and connect with you guys for sure. So appreciate those resources. Two quick questions for you before we let you go. The first one is digital assets, crypto. Is that the new gold?
It's an asset class that's untested under a variety of market conditions. And I would say you'll have to get into a nasty bear market in equities and see how it performs. And if it is performing as well as gold or better than gold, perhaps it's the new gold. If it's not, then I think you'll have to conclude that it's a speculative asset. It may have a place in a portfolio, but not as a substitute for gold. Again, I think time will tell if it can outpace gold. Certainly in the context of April of this year, in the context where we had real compression in equities, Bitcoin, Ethereum, a whole host of cryptos sold off in concert with equities while gold held its own. If you go back to 2022, equities are under pressure. You've got the NASDAQ, Dow, and S&P off in a range from 15 to 30%. Crypto is also selling off at the same time, and gold is doing quite well. So at least in recent history, with some corrections, it's behaving like a risk asset, not like wealth insurance, which is what that's how you should see your physical metals is wealth insurance. Right. So in recent history, it's failed. Will it outperform in the context of a secular bear market in equities versus just a cyclical dip? I would suspect that it's going to underperform, but I could be wrong.
Yeah. I know I just did a recent podcast on this very subject where I showed them on the chart saying, hey, look, SP dipped, so did Bitcoin, but gold, silver took off, right? We're still waiting to see if there's that evidence of that digital gold or not, but I agree. It seems like more like a speculative asset than an actual, like a real hedge, if people were to call it that.
Your second question.
Yeah. Second question is this obviously being the Money Ripples podcast, we talk about the creating a ripple effect in people's lives. David, what's your ripple effect that you're here to create on this planet?
What I would love to see is families engage with all of their resources on a more comprehensive basis. We tend to think of our real estate, our ounces, our shares as the piece that we're managing and leaving for the next generation, when in fact, what we really manage and what is far more important are the intangibles. learning to love, learning to forgive, learning to be gracious and kind and hospitable. These are things that take place in the context of family life. And an individual can choose to prioritize their values and develop as a human being their emotional capacities, their spiritual capacities, their intellectual capacities. And you don't get a balance sheet statement. You don't get a monthly report to see if you're in the red or in the green, which
Right.
is, I think, one of the reasons why it's neglected. I would love to see people look at their complete balance sheet and see that the intangible assets that they're managing are actually far more important than their tangibles. So we may be in the tangible business, but we care about the hearts and minds of individuals, our clients, the families that we have the opportunity and privilege to work with. And we think that the ripple effect is, if they're managing those resources well, there is very significant social and societal change, and that's the ripple effects I'd love to see.
So agree. Yeah, family is definitely a better, much better investment that lasts through the test of time and markets and everything else, right? It's always come back to that.
That's right.
Yeah. Well, David, I appreciate your time today. Thank you so much for joining us.
Privileged to be back. I look forward to joining you again.
Absolutely. Everybody else, there you have it. Gold, silver, all that, obviously wealth protection and definitely a wealth hedge for sure. So if you want to learn more about that, go to McAlvany.com like we have in the show notes there. But guys, make sure you go and make it a wonderful and prosperous week, and we'll see you later.